Stock Market Psychology. 5 powerful ways loss aversion affects your investments. Here are the lessons to be learned. Lesson 1. Loss aversion makes losses feel twice as painful as gains, driving irrational stock market decisions. Lesson 2. Holding losing stocks too long stems from fearing the emotional hit of selling at a loss. Lesson 3. Selling winners too early sacrifices big profits due to loss aversion's need for quick security. Lesson 4. Avoiding risky stocks because of past losses can block you from high growth opportunities. Lesson 5. Panic selling during downturns locks in losses, as loss aversion overrides long-term strategy. The emotional sting of loss aversion. Dive into the mind-bending world of loss aversion, where losing 100 pesos stings twice as hard as gaining 100 pesos thrills. Rooted in psychology, this bias, first uncovered by Daniel Kahneman and Amos Tversky, shows we're wired to dodge losses more than chase gains. In the stock market, this means you might cling to a sinking stock, praying for a rebound, rather than cutting your losses. Picture your brain as a drama queen, amplifying every dip. This chapter hooks viewers with the science behind our fear, setting the stage for how it hijacks investment choices. Holding losers too long, the sunk cost trap. Ever held a plummeting stock, whispering, "It'll bounce back"? That's loss aversion's grip. Investors often refuse to sell at a loss, treating it like a personal defeat. Imagine buying at 50 pesos, watching it crash to 30 pesos. Selling feels like admitting failure. So you wait, hoping against hope. This chapter paints a vivid scene: a trader staring at red numbers, paralyzed by the pain of realizing a loss. It's the sunk cost fallacy meets emotional roulette, costing you more as the stock sinks deeper. Will you break free? Stay tuned. Selling winners too soon, missing the big payoff. Flip the coin. Loss aversion also makes you dump winners prematurely. Picture this: your stock jumps from 100 pesos to 120 pesos. Elated, you sell to lock in that gain, fearing it'll vanish. But what if it rockets to 200 pesos? Studies show we feel gains less intensely, so we cash out early, dodging the risk of losing profits. This chapter dazzles with a roller coaster analogy, jumping off at the first peak instead of riding the full thrill. It's a profit killer in disguise, and you'll see why patience could have been your jackpot. Avoiding risky opportunities, the safety net mirage. Loss aversion turns you into a financial scaredy cat. Rather than betting on a promising stock with a chance of loss, you hoard cash or cling to safe bonds. Imagine passing up a startup that soars because a past flop still haunts you. This chapter draws you in with a treasure hunt twist. Fear of losing the map keeps you from the gold. In the Philippine market, where growth sectors like tech beckon, this bias could mean missing massive gains. Are you trading potential for a false sense of security? Let's find out. Panic selling in downturns. The market meltdown trap. When markets crash, loss aversion ignites panic. As stocks tumble, the pain of paper losses say, a 10,000 pesos drop feels unbearable, pushing you to sell everything. Flash to 2022. The S&P 500 dipped, and loss-averse investors bailed, missing the rebound. This chapter grips you with a stormy sea metaphor, abandoning ship just before the skies clear. It's the opposite of buy low, sell high, locking in losses instead of riding out volatility. Will you master your fear or let it sink your wealth? The finale inspires a bold rethink.